Hello and welcome to this edition of Keys to the Market with Raisa Lawson, Realtor at the House Store, serving Knox and surrounding counties. On today's episode, we're going to talk about a buyer key. We're going to talk about some myths and misconceptions in the lending process. And my special guest today to help uncover these mysteries is Alicia Howard with Rocket Mortgage. Thank you for being on the show today.
Thank you for having me.
You're very welcome. So, can you tell our viewers a little bit about you and your company?
So my name's Alicia Howard, and I've been a mortgage loan officer in Tennessee, Virginia, and Georgia for 25 years now. And I work for Rocket Mortgage, which is one of the largest lending companies in the United States. And I am part of the local division. So I am here local representing Rocket Mortgage.
Yeah, so a lot of people I hear sometimes, this is a little bit off topic, but I've had several people just recently say, oh, well, I got a pre-approval through Rocket Mortgage, but it was like somebody off somewhere. So if they have done that, can they transfer that over to you to have a local contact?
It depends on how far they are in the process, but we are trying to get more people to know that we are boots on the ground in local markets, and we are here, and it works sometimes more efficiently with the realtors to have a local person. So it depends. So reach out if you do have that experience.
Okay, perfect. Okay, so down to our myths and misconceptions. So the first one we're going to talk about is you have to have 20% down to buy a house.
So that is definitely a misconception. The markets today allow for a first-time buyer to come in for sometimes, depending on down payment assistance, with zero. Or if you have your own down payment, it's generally 3 to 3.5% down. And if you don't put 20% down, the myth comes into play that you have to pay mortgage insurance. And mortgage insurance is a word that our parents and our grandparents did not like. They didn't want to hear it. They thought it was a premium that was unnecessary. Those premiums have changed. In 2024 and 2025, they began lowering those mortgage insurances, which is part of your monthly payment. So if you don't put 20% down, you're absolutely fine, because sometimes your money can work harder for you in other places. If you're not a first-time home buyer, you can even utilize FHA's program with only 3.5% down. You do not have to be a first-time home buyer to use FHA loans. If you're not a first-time home buyer, then you can utilize a 5% down program on a conventional loan. And when you reach a certain loan to value, that mortgage insurance can be dropped on conventional, and you can refinance off of an FHA loan to have it removed.
Okay, good information. So you have to have 20% down, definitely a misconception. Okay, our next one up is you, and a lot of buyers I think get very scared of this, you shouldn't buy a house when the rates are high.
And we have to consider what is a high rate. Where we're at now historically is not a high interest rate.
Exactly.
Our grandparents paid 18 to 24. Our parents sometimes had 18%, and now we are in a 6 to 7% market. COVID came in and had historically low interest rates. Will that come back? If you're counting on it, you may be wasting your money, because if you're not buying, you're probably renting or living with your parents. And we all know we don't want to live with our parents for an eternity. And 6 to 7% market is not a high interest rate. You can pay it to your equity to build assets in a home, or you can pay it to a landlord and they're going to build their assets and equity in the home that you're in. So I don't think it has a lot to do with high interest rates. Comparatively and historically, we are not there right now. We do have great interest rates, and we encourage people to purchase homes if you can versus renting.
That's a very great point, because if you are renting, you are just basically giving your landlord the money every month and you don't have anything tangible to show for that. So even if you're looking at a little bit higher interest rate than where we were, in the long run, when you're just giving that rent, and rent is high right now. So when you're paying that amount every month to a landlord, as opposed to you could be paying your mortgage, the offset, even though the rates might not be historically low, they're still good, and it's still a much better option than to be paying rent to someone.
Yes, because you're building your landlord's wealth.
Yes.
And you could be building yours. Because even though rates are where they are, the amount of equity that grows with, especially our market here in Knoxville and surrounding counties, the increase in property values is also building you wealth.
Yes. That's a great point too. Okay, so our next myth or misconception is a pre-approval will guarantee you to buy a house.
Okay, so pre-approval process is much better than pre-qualification. If you're pre-approved, that means your lender has already seen your assets, your income, and your credit, and they have said, yes, this is what you can afford, this is what you can buy. However, if you have a conversation with your lender about single-family homes, and then you find a manufactured home, that could change your approval process. You find a condominium, a true condominium, that can affect your approval process. If you start your application, you're approved, but then you change your job, or you are moved to a different department in your job, your pay changes, anything that changes from that pre-approval process, you really need to involve your lender, because just because they sign off on it in the beginning doesn't mean 60 days later when you find a home, your situation is exactly the same, and it must be that. If it changes, reach out to your lender, have a conversation, and sometimes the collateral, the house itself, can affect what type of pre-approval you have. Are you pre-approved to buy a manufactured home? Is the condominium complex approved for the type of loan that you've been pre-approved for? So in the pre-approval process, make sure you communicate with your lender and your realtor about, this is what I'm approved for. Oh, I'm outside of that now. Let me call my lender back and say, hey, I've changed my mind. I want to do this. Or if you get a job offer in the middle of your pre-approval, just pick up the phone and call your lender. Don't necessarily say, I can't take that job because I'm pre-approved. Or don't take it, not tell your lender, and then the income be different. Just getting paid differently, like going from hourly to salary or salary to hourly, especially if you had overtime previously and that was being used for your approval process. So anything can change after you're pre-approved. It's all about communication with your lender and your realtor about any changes.
Okay, great. That's very good information. Okay, so the last one up on our list, self-employed buyers can't get loans. I know we've heard a lot of myths about that for so many years, and I've even personally had so many self-employed people come to me and say, I can't get approved for a house. You know, we've tried and we just can't get approved. So myth or misconception?
That is a myth, because a lot of self-employed borrowers, of course we know, depending on if they're paid by K1 or they're sole proprietor, their tax returns, CPAs, and the clients are allowed to deduct certain expenses off of their taxes. Most self-employeds do deduct enough to where their taxes are lowered, but again, their income is lowered, and we do have to follow the ability to repay. However, we have what is called bank statement loans. A self-employed person that has been self-employed for at least 2 years can apply for a home loan using the income of their last 12 months bank statements. And we will add their deposits, and we will give them a certain percentage credit toward those deposits toward income. And I do bank statement loans quite a bit. You can get in for as little as 10% down. And those are specialized loans, so there's no mortgage insurance, even if you only put 10% down. So self-employed borrowers, also keep in mind, if you've been self-employed more than 4 years and you do claim income, most of the time we can get approval with your most recent year's tax returns. You don't have to dive into 2 years if you've been self-employed for over 4 years. However, the alternative is the bank statement loan, and it works beautifully for people who have some assets. They do have deposits they can show, and we can even use bank accounts that are in your personal name if you're a sole proprietor. It doesn't have to be in a business name. So there's all kinds of creative ways for self-employed buyers to call lenders and see if they're pre-approved.
Okay. And I know when I had people come to me and say that, I was like, yeah, I think we can get you approved, even though you're self-employed. And that's the key, is working with the right lender, working with a realtor that knows the avenues also, because you need a team that's going to work for you throughout the transaction. You need your lender to know what avenues are afforded to you. You also need your realtor to know that as well. So making sure that you choose both that have experience with these types of loans, that's just going to help further the process for you, make it easier. But it's definitely a myth. If you are self-employed, you can buy a house.
Absolutely.
All right, so that was a little fun take on today's myths or misconceptions. So we hope you found this information to be very informative. And Alicia, thank you so much for being on the show today.
Thank you for having me.
And just remember, Raisa Lawson, Realtor at the House Store, if you're looking to buy or sell a house, because every move matters.